All right, let's talk about something that's on every investor's mind. How do you spot a company that's heading for trouble before it's too late? Today, we're going to build a toolkit, a set of skills to help you look past the official story and see what's really going on under the hood. You know that feeling, right? One day a company looks like a sure bet, the next it's in total freefall. It can feel like these disasters just materialize out of thin air. But what if I told you the clues are almost always there? They're often just hiding in plain sight, buried in financial reports or in the actions of executives. The trick is knowing exactly where to look. So let's start building our toolkit to do just that. So where do we start? Well, think of our first tool like a complete medical checkup for a company. We're going beyond the surface level stuff. We're going to run some financial diagnostics, check its vital signs, and see if there are any hidden problems we need to worry about. Now, the discipline we're borrowing from is called forensic accounting, and don't let the name scare you off. It's not just for lawyers and courtrooms. For us, it's about putting on our detective hat, pulling out a magnifying glass, and really digging into the numbers to find the story they're actually telling. And one of the best tools in that detective kit is something called the Altman Z-score. Now, this thing has been around since 1968, and there's a reason for that. It works. It basically takes 5 key numbers from a company's financials and boils them down into a single score that tells you how likely it is to go bankrupt. And this chart, well, it shows you the danger perfectly. Back in 2020, this company's Z-score was a healthy 3.2. But just watch what happens. Year after year, it's a steady, relentless march downwards. This isn't just a bad quarter, it's a trend. It's a clear path heading straight for trouble. And here's where it ends up, 1.5. So why is that number so bad? Because the red line, the threshold for serious distress, is 1.8. Anything below that, and all the alarm bells in your head should be going off. This company isn't just approaching the distress zone, it's already deep inside it. But look, a good detective never ever relies on a single clue. The Z-score is screaming danger, but we need to see if other evidence points in the same direction. So let's build out our case by looking at something really fundamental. Is the company actually any good at making money? Let's check its profitability. Wow, this table tells a pretty chilling story. Your net profit margin is simple. It's how many cents of profit you make for every dollar of sales. So in 2020, this company was keeping 8 cents of every dollar. By 2024, that has just collapsed to 2 cents. That's a 75% drop. That's huge. When you see margins getting squeezed this hard, it means the business is in a tough spot. Either its costs are spinning out of control, or it can't charge what it used to, or maybe both. This is what you'd call a 5-alarm fire for any investor. And the bad news just keeps piling up. The company's taking on more and more debt, its ability to pay its immediate bills has dropped below a safe level, and maybe most importantly, the actual cash it's generating from its business has absolutely nosedived. These aren't just abstract numbers. They are clear symptoms of a very, very sick company. Okay, so we've looked at the what, the numbers. Now let's shift gears and look at the who. We're talking about the company executives, the directors, the ultimate insiders. They know what's really going on. So when they start selling their own stock, you need to pay very, very close attention. This is our second tool. Now, the key here is learning to separate the signal from the noise. An executive selling a small number of shares on a schedule to pay their taxes, that's just noise. You can probably ignore it. But what about multiple insiders, all of a sudden selling huge chunks of their stock at the exact same time? That is a signal, and it's usually a very, very loud one. But, and this is a big but, context is absolutely everything. Just look at these examples. The CEO of Nick Scali, he made a big, unscheduled sale. That might look like a red flag, right? But it turned out he had a good reason. He was buying a house, and no one else was selling. The stock did just fine. So you see, you gotta do a little homework. Now, let's look at the other side of that coin. Kogan, Setir, Drone Shield. Here the pattern is just crystal clear. You've got the top brass, the CEO, the CFO, the chairperson, all rushing for the exit at the same time, dumping big, non-routine chunks of stock. And just look at what happened to the stock price afterward. These were massive, flashing red flags. So if there's one thing to take away from this, it's this. It's not if insiders sell, it's how they sell. The size of the sale, the timing, and who else is selling with them. That's what really matters. That's what separates a meaningless transaction from a powerful warning. Okay, so we've looked inside the company, at the books, and at the insiders. For our third and final tool, we're going to look outside the company, at all the chatter and the hype, Because sometimes the danger isn't that a company is failing on its own, it's that it's being illegally manipulated. And this brings us to the classic pump and dump scheme. This is a nasty type of stock fraud where scammers will hype up a stock, usually a tiny unknown company, with a bunch of fake news to get the price to soar. Then, once regular investors like you and me pile in, they dump all their shares. The price crashes, and they walk away with the profit. The playbook for this is actually pretty simple. It's a four-step process. First, the scammers quietly buy up the stock when it's super cheap. Second, they start the pump. They create a frenzy with emails, social media posts, all that stuff. Third, as people start buying, the price just skyrockets. And finally, the dump. They cash out at the top and leave everyone else holding worthless stock. So how do you protect yourself from this? Well, this right here is your checklist. You have to be deeply, deeply skeptical of any unsolicited tips. If something sounds way too good to be true, it is. Be really careful with promotions for these obscure little companies. And if you ever see a stock's trading volume just explode for no good reason, that's a massive red flag. All right, so we've got our 3 tools: checking the vitals, decoding the insiders, and vetting the hype. Let's pull them all together now into a single practical toolkit you can actually use. This is your key takeaway. A simple 3-point checklist. First, you've got to be a financial detective. Check the company's vital signs. Second, you have to be a bit of a psychologist. Analyze what the insiders are really doing. And third, you have to be a skeptic. Always question the hype and where it's coming from. And this is so important to remember. None of these tools is foolproof on its own. A bad Z-score could just be a blip, and insider sale might really be for a new house. But when you see a company with declining financials, and you see clustered insider selling, and you see a bunch of questionable promotion, that's when the picture of risk becomes crystal clear. And that really brings us to the final big question. In this age of just constant information, how do you protect your portfolio without becoming cynical about every single investment? Well, the answer isn't to be pessimistic. It's to have a process. It's about replacing fear with a structured way to look at risk, so you can invest with confidence. The goal isn't to always find a reason to say no, but to build the conviction to say yes to the right opportunities.